I think higher rates are probably a bigger risk for some parts of the market than others. I don't discount that threat overall as being something to just completely ignore. But the data suggests stock prices have tolerated much higher interest rates historically. And if rates are rising because the economy is growing and people are making more money, higher rates will be tolerated yet again. So this is nothing new. We've seen rates come off of emergency levels following World War II. Throughout the 1950s, interest rates rose. Stocks went up pretty much the entire time. There was one recession the whole decade. We saw rates rise throughout the 1960s. It was one of the best periods for stocks in human history. Rates rose in many periods of time where stocks also did okay. So a lot of this is a function of what else is going on, what are the other variables. So here's the big variable. The Fed thinks it's not going to have to raise rates based on its dot plot until sometime in late 2023. We all know that that's probably not going to stay that way, that expectation. When you look at the average economist talking about 6% GDP growth and the Fed thinking more like 4%, the truth is probably somewhere in the middle for this year. And it's probably more likely that we're talking about rate hikes sometime in 2022. So the market will have to adjust as those two opinions or data sets converge. And maybe that means a 10-year 1.7, 1.8. It's really not going to be a big competitor to people buying stocks instead of bonds until it gets closer to 3%. And I think if that's the reason why you're underinvested for your future right now, probably a mistake in the long term.
These same fund managers, are talking about 2%, Jenny, on the 10-year could be the level of reckoning. I mean, do you see this now as the biggest risk for investors, the trajectory of interest rates? Because there's so much optimism about the reopening. Right? Josh has talked about it. We've all talked about it. We're going to go nuts. We can't wait to get out there and spend money and travel and do all those things we haven't been able to do for the last year. But with that comes the prospect of higher interest rates, which then forces someone's hand, perhaps, that affects the stock market.
Josh really nailed his description of it, and it's not about the exact number. It's not about 2%. It's not about 1.75. It's not even really about 3%. It's about how we get there and why we get there. And so let's say we're at 2.5% on the 10-year, but we've gotten there because we have a robust economy. Everything's going well. We're going to tolerate it. And then we're going to say, like, oh, the next level is going to be 3% or whatever it's going to be. But we're going to adjust. It's all about the path. It's all about the economy, the economic support, the business climate that stands behind the number. It's not just about the number. I do think as interest rates go up, you see a shift in what's doing well. We've seen that really painfully, obviously, this year. So you see a shift. But I think it's tough to say interest rates have gone up and that's caused a market correction. It hasn't. Guess what? The S&P's up 6% year to date. That's following a year where it's up 18%.
You're not wrong. I mean, it hasn't caused one yet, but you say it's all about the path. There are others who suggest it's all about the pace.
So what if it does? Why is it so terrible to have higher rates and a stock market correction? You had one in 1994. You had a surprise rate hike from Greenspan because things were heating up faster than they had expected after very, very low monetary policy as a result of the S&L scandals and that recession in 90-91. So in 94, they have to raise rates. The market's caught off guard. The S&P corrects 20% and then triples. Who cares? Why is a market correction the end of the world? Arguably, we just had one in the NASDAQ.
20%? I mean, John Najarian cares.